Welcome back to Learn SKN, and today we have an economics video for you, a CSEC economics video. So the last economics video we did would have been completing section 4. So we looked at market failure and the consequences of market failure, etc. So we would have completed section 4, and so now we are going to move on to section 5, which is the financial sector. And some of the content I'm going to cover here, I would have covered already in the POB videos that were entitled the financial system or business finance. So that would have some aspects of some of the content here, but not all, because that's one of the differentiators between economics and POB. Economics go deeper into the financial sector. You go into different parts of the financial sector that POB would have just browsed on. All right, so we're going to just jump into that right now. So the first specific objective in the syllabus is explain the concept of the financial sector. And so we have a little definition here, a little explanation here in the syllabus itself, where it says the financial sector, the complex mix or network of markets, households, business, government, laws, and institutions interacting with one another. Economic activities that are not officially regulated and which take place outside the formal norms of business transaction. And so that's a little rough understanding of what the financial sector is. But a more simplified way of looking at the financial sector is just a mechanism or a system that brings borrowers and lenders together. That's in just simple terms. So here we have another definition here in this economics textbook. The financial system is made up of financial institutions and that coordinate the actions of savers and borrowers. Financial institutions can be grouped in two different categories: financial markets and financial intermediaries. So that's a rough overview of what the financial sector is. The financial system consists of the group of institutions in the economy that help to match one person's savings with another person's investment. It moves the economy's scarce resource from savers to borrowers. So that's a rough understanding of what the financial system, financial sector is. It's that mechanism that brings the borrowers and the savers into contact. So it channels the financial instruments for the savers that the savers would save, and allow the borrowers to borrow from the savers. If you look at it really and truly, the financial system is normally about money, and there's really how many things you can do with money. You can either save money or you can consume money, right? So you can either save it or consume it. Your marginal propensity to consume or your marginal propensity to save can be affected by various factors. But that's what you do with money. You either save it or you consume it. So you can invest it also. You can invest your money for later rewards, later gains. But for the most part, you consume it or you save it. And so the financial sector or the financial system allows for this saving and borrowing. And the system, just like any economy, it is made up of multiple players. And so those players include the government, the private sector, public sector, those kind of persons. So everybody in the economy would also be a part of the financial system or the financial sector. And so the textbook starts out with money, so we have to scroll all the way down to understand, and we're going to go back up to understand what the financial sector is. So the financial sector is that part of the economy involved in financial businesses. These businesses act as links between spenders and savers. So they are called financial intermediaries. So again, another simplified definition for the financial sector. Right? So that's an easy enough definition to work with. What are the functions of this sector or this system? The functions. So according to your textbook, the financial sector has many functions in the economy. It attracts funds from businesses and private individuals. Firms and individuals with extra funds are encouraged to save in financial institutions. It provides people with an alternative place to put their extra funds. Note, too, that the financial sector performs the important function of encouraging those who might not otherwise have saved to save some of their income. It makes saving attractive by paying interest on the sum saved and by keeping the funds secure. The financial institutions are supervised by the central bank. A strong financial sector gives savers confidence and people feel that it is safe to deposit their savings. Again, remember, we're talking about the savers and the borrowers. And so the financial system, our sector, it attracts funds from businesses and private individuals. So they say, okay, you come, you save your money. Annually, we're going to put on a little 5%, 2%, whatever. So they try to make it attractive for you to not spend all your money. So that's why some people would say, instead of putting your money under your mattress, under your pillow, put it on a savings account, because you're going to get some returns, you're going to get some interest. I mean, the reality is the interest tend to be kind of low, especially today with the slowdown in the economy. But some financial institutions have different facilities. They have different saving mechanisms. You might have a fixed deposit where you deposit your money, leave it for a couple of years, and then you get a greater amount of interest on that money. Like, for example, 5% annually instead of the 2% for the regular savings. So they have special high yield savings that would encourage persons to come and save their monies. It affords these businesses and private individuals an opportunity to earn interest on their idle money balances. So that's what I said just now. So when you put your money in various account deposits, you can earn interest. You're gonna get something. I mean, the reality is that for the basic savings system, basic saving accounts, you're not gonna make much in the form of interest. Maybe a 2%, 1%, whatever the bank rate is. But there are specialized savings where you can get higher yielding interest rates. It provides the government with a source of funds for investment purposes. Banks use the funds deposited with them to purchase treasury bills and bonds issued by the government. This constitutes a loan to the government. This is discussed in chapter 15 that we'll look at later on. So they're saying that the banks can now take that savings and invest it, right? So they can lend it out to the government, and that would in turn give the government some source of funding for various capital projects and those kind of things. Because some of the treasury bills and bonds, they're not due until maybe 30 years or 10 years, that kind of stuff. So the government have more than enough time to repay the bank with nice interest. Also, apart from the government, it provides the private sector with a source of funds for investment purposes. Financial institutions purchase or facilitate the purchase of corporate bonds and company shares. The purchase of corporate bonds provide loans to businesses. The purchase of company shares provides equity capital to businesses. Right? So what they're saying is that because you're saving your money, the bank also facilitates the money market. So it also facilitates the buying and selling of bonds and shares, which are part ownership of businesses, and it helps businesses to raise capital. And sometimes the business want to raise some money in order to invest elsewhere. You want to you want to build a new plant, you want to get some more capital to do something else. You can hit the money markets, hit the bond markets, sell your shares to get more money to enhance or develop your business further. And the financial system allows for that to happen. You have your stock, like your New York Stock Exchange, you have your Nikkei, you have the FTSE, you have all these different exchanges that are used to facilitate the buying and selling of bonds and shares and those kind of things. And of course, now you have different kind of markets. When you have the Bitcoin thing going on now, the cryptocurrency, where you have those kind of new ways of getting financing for various endeavors. So those are some functions of the financial sector. Then we have, it provides private individuals with a source of funds for investment or spending. Private individuals can borrow from financial institutions to buy homes, cars, as well as to go on foreign trips or start up a business. Of course, to go to college also. You know, you have to invest in education. So again, you want to go to college, you want to build a home, you go for your mortgage to get your home. I mean, and so you see, without the financial sector, you might not be able to buy a house cash. You cannot put up enough money under your mattress to buy a nice or build a nice home. So you need the financial sector, financial system for this. To buy a car, sometimes you don't have enough money, you're not rich enough to spend out of the pocket. So you go, get some monies to buy a car. So they facilitate the borrowing of monies, the borrowing of obtaining of financing for both the government, businesses, and private individuals. It allows the private sector and private individuals the opportunity for part ownership of companies. Through the purchase of company shares, private individuals are part owners of companies. Holders of ordinary shares have voting rights in companies. If Company A buys some shares from Company B, then Company A is a part owner of Company B. So again, we look at the money market, the securities market. They can be used by, you can use the financial sector, the financial institutions, to facilitate the buying and selling of shares, as I said before. And if you buy your shares, you can earn your dividends, so you earn the next side income just like that. And that is facilitated by the financial system with its many different mechanisms. It provides compensation when mishaps occur, thus reducing risk in the economy. There is insurance for firms and individuals. Insurance companies provide compensation for policyholders in the event of loss. They provide this service for a fee called a premium. So yes, so the insurance companies are also a part of the financial system, the financial sector, and they help to facilitate compensation in the event of a loss. So it helps with the risk bearing. So therefore, if you know there's some form of compensation in place, then companies will not be afraid to invest. So this can help to encourage or incentivize companies to invest more money, knowing that if something goes wrong, they are covered by insurance. This also applies to individuals, so that you can take more risk because you know you might be covered. You might buy a car, feel comfortable buying the car, knowing that if the car gets in an accident and it's not your fault, insurance is going to help you cover that. And some insurance actually facilitate savings also, and some of them, the premium, the policy has certain attributes that can be used as security and things like that. So if you're paying into insurance for long enough, you can use some of that money to buy a home, a car, whatever. So they do engage in the financial sector, the insurance companies. And so that's about it for the main functions of the financial sector or the financial system. And if you can say that the financial sector is the above table sector, that, you know, those are things that are done on the up and up. But those are things that are counted also in a country's GDP and those kind of calculations. But then there's what you call the informal sector. Right? The informal sector is a part of the economy where economic activities are not under official control. Caribbean economies have very large informal sectors. The business activity in this sector is not included in the official business activity. Production in this sector is not considered in the computation of national income statistics. Income earners in this sector do not pay taxes. And so this is the next whole, what you call the underground economy or the informal sector. And so I know it might sound dark and, you know, deadly or something like that, but it's not all bad, right? It's not all bad. So for example, if you go and babysit for your neighbor, collect some money on that, that's informal. But it's not illegal, but it's informal. Because you're not going to report that to the authorities. The authorities have no clue what's going on. So that's part of the informal sector, the underground economy, but it's not illegal. Again, if you go and repair a computer, a fridge, or something, that's a little side hustle of yours. You go and repair it for your neighbor. You go and cut the lawn for your neighbor, cut the grass, whatever, get your little small change. Again, that's part of the informal sector because it's not registered. It is not going to be calculated in GDP, but it's not illegal. But of course, you know, there's also illegal aspects to the informal sector, the underground economy. So, you know, you have your prostitution, the drugs, and that kind of stuff. Yes, those are illegal, and those are also a part of the informal sector or the underground economy. So that's the next side of this whole coin. So you have the formal one, which is the financial sector or the financial system. Everything is counted, it's above board, that kind of thing. You have the banks facilitate these different transactions. You have various functions, but then you have the informal sector or the underground economy, where these actions, these transactions are not really recorded. They're not really under the control of the official authorities, and they are not part of the overall national income calculations, but they are done. It's not like all of them are illegal, but you know, some they are not recorded. So that's what we call the informal sector. And don't get me wrong, this sector, the informal sector or the underground economy, has its place in any economy, because you cannot always want to go through all of the red tape to talk about reporting this, reporting that, paying that tax, paying this tax for a little small side hustle. So you don't really want to be a part of all of that. So sometimes the national statistics might say X amount of persons are unemployed, when the reality is maybe they just get turn in hand, you know. They go pick some guava or jelly or coconut or whatever, sell them on the right side of the road. Got some bananas or something, sell on the side of the road. They don't really record anything, and so they will be considered part of the informal sector, right? So those are the two different viewpoints you can look at. And so we're going to stay here for now. So today we would have covered the definition of the financial system or the financial sector and its functions. And we also mentioned the informal or the underground economy. So that's about it for this video, right? So the next video we're going to look at money. Now the reason I'm saying is because money might take a while to explain, because we have different components of money. You have to look at the qualities of money, functions of money, how money was developed. So we're not going to look at it in this video. Next video, we're going to jump into money, the concept of money. So make sure that you subscribe, you like the video, and you hit the notification bell so you know when Learn SKN drops the next video from the economics syllabus. All right, thanks for watching, thanks for listening.